Welcome back, knowledge seekers. In this audio, we'll be exploring the key takeaways from chapters 3, 4, and 5 of The Intelligent Investor by Benjamin Graham. So grab your headphones and get ready to learn something new. Chapter 3 of The Intelligent Investor by Benjamin Graham is titled The Defensive Investor and Common Stocks. In this chapter, Graham focuses on the characteristics of a defensive investor and how they can approach investing in common stocks. According to Graham, a defensive investor is someone who is primarily concerned with the preservation of capital and who is not willing to take on a significant amount of risk in order to achieve high returns. Defensive investors are typically more conservative in their investment approach and are not looking for the next big thing or high-growth opportunities. Graham recommends that defensive investors focus on a few key principles when investing in common stocks. Diversification. Defensive investors should aim to diversify their portfolio across a range of different stocks in order to minimize their risk exposure. Graham suggests that investors hold between 10 and 30 stocks in their portfolio. Quality. Defensive investors should look for stocks of high-quality companies with strong financials and a track record of stable earnings. Graham recommends focusing on large-cap stocks with a long history of paying dividends. Value. Defensive investors should aim to buy stocks that are undervalued by the market, meaning they are priced below their intrinsic value. Graham suggests using fundamental analysis to identify undervalued stocks. Patience. Defensive investors should have a long-term perspective and be patient with their investments. Graham recommends holding onto stocks for at least 5 to 10 years, and even longer if possible. Overall, Graham's approach to investing in common stocks as a defensive investor is to focus on minimizing risk while still achieving reasonable returns over the long term. By diversifying across a range of high-quality, undervalued stocks and being patient with their investments, defensive investors can build a solid portfolio that will withstand market fluctuations and preserve their capital over time. Chapter 4 of The Intelligent Investor by Benjamin Graham is titled General Portfolio Policy, The Defensive Investor. This chapter builds on the principles discussed in the previous chapters and provides more specific guidelines for how defensive investors can construct their portfolios. In this chapter, Graham emphasizes the importance of a balanced, diversified portfolio for the defensive investor. He recommends dividing investments between stocks and bonds, with the percentage allocated to each asset class depending on the investor's age and risk tolerance. Graham suggests that young investors with a long investment horizon can afford to have a higher allocation to stocks, while older investors or those with a lower tolerance for risk should have a higher allocation to bonds. He also recommends that investors consider using index funds or exchange-traded funds, ETFs, rather than trying to pick individual stocks, as this can provide diversification and minimize risk. Additionally, Graham advises that investors should regularly review and rebalance their portfolios to maintain their desired asset allocation and adjust for any changes in their risk tolerance or investment goals. Overall, Chapter 4 provides a practical guide for defensive investors on how to construct and maintain a balanced, diversified portfolio that is tailored to their individual circumstances and investment objectives. By following Graham's guidelines, investors can minimize risk and increase the likelihood of achieving their long-term financial goals. Chapter 5 is titled The Defensive Investor and Common Stocks. In this chapter, Graham discusses the different approaches that defensive investors can take when investing in common stocks, including the distinction between active and passive investing. Graham defines active investors as those who try to beat the market by picking individual stocks and timing their trades. He notes that this approach is risky and difficult to consistently achieve, and recommends that defensive investors instead focus on passive investing, which involves buying and holding a diversified portfolio of stocks for the long term. Graham also emphasizes the importance of value investing for the defensive investor, which involves buying stocks that are undervalued by the market. He recommends using fundamental analysis to identify stocks with strong financials and a history of stable earnings that are priced below their intrinsic value. Additionally, Graham discusses the role of dividends in the defensive investor's portfolio, noting that dividend-paying stocks can provide a steady source of income and help to minimize risk. He suggests focusing on stocks of companies with a long history of paying dividends and avoiding stocks that pay out too much of their earnings in dividends, as this can be a sign of financial instability. Overall, Chapter 5 provides further guidance for defensive investors on how to approach investing in common stocks. By focusing on passive investing, value investing, and dividend-paying stocks, defensive investors can build a solid portfolio that is designed to withstand market fluctuations and provide reasonable returns over the long term.